What is up, guys? Welcome back to my channel. My name is David Hanlon, aka The Laptop Legend, and in today's video I want to explain the different types of orders that you can use when trading stocks, because there's a lot of different types and they're good for a lot of different things. And if you're a beginner, you might not understand how you should be using these. And I actually had someone who used an order incorrectly. They wanted to use a stop limit order and they ended up using a limit order. So if you guys don't understand exactly the nuances of these orders, this video is for you. I should make it very easy to understand. That's my goal, at least. And yeah, hopefully you find this video helpful. Also, if you guys have been watching my channel for a while, you should know by now that I have a lot of laptops, and you might be seeing this in the background. I might have to change my name now to the Desktop Legend because I was tired of Fidelity Active Trader Pro crashing on me when I was trading on a Mac. So I got a PC and I got an external monitor, and it's going to be awesome. So I'm looking forward to that tomorrow. But yeah, let's talk about the different order types and see what I can teach you guys. All right, guys, so I'm here on my laptop, and this is the Fidelity Active Trader Pro platform that I love to use for trading. You can see here, it's currently outside of normal market hours just because I could not find time to do this video with all the work that I've been doing in the Discord. So again, if you're not in that, definitely go check it out. But I have a screenshot of what this looks like during normal market hours, and I just want to walk through every single thing so you guys know what everything is. Condition is it's a way you can place multiple orders at the same time, depending on who your broker is. I literally just leave this as none. Don't overthink this. Most of you guys are never, ever going to need this, and if you do, it's a lot more advanced stuff. I've never used this personally, and I don't think it's necessary. So let's move on to TIF. This is time in force, and this is basically how long your order is going to exist out there in the digital universe. So most of the time, I have this set to be day or day plus, and that means that the order, if it's not filled by the end of the day or by the end of extended hours, it disappears and it's erased from existence. It's expunged. The other thing you can have there is good till canceled, and this means that the order is in existence for 180 days. And this is a little bit dangerous because you could potentially get executed when you forget that you even had an order. So I mean, it could execute 170 days after you place the order and suddenly you bought this stock when you really weren't feeling like it. So this is not really a good option, especially if you're someone who's in the market every day. You know, if there's a specific stock that you know for sure you want no matter what under a certain price, then maybe this is a good idea, because if you can't watch the markets, you know, maybe it drops down 90 days from now and you're able to grab it at that price. So potentially you could use this then, but for the most part, you're going to want to use day, especially if you're day trading. You know, there's no stock that you're going to be day trading that you want for sure at a specific price if it's not on the day that you want to trade it. Moving on to route. This is basically, imagine there's a bunch of different highways that all go to the same place. That is what routing is. And you can buy your shares through different market makers, and they'll all get you the same shares. Some have, you know, different fee levels, whatever. But normally I just put this on auto because I trust Fidelity to make the best decision. I haven't really gotten into all the different types of market makers and all the different routing for your orders. To me, that's not super important at this point because auto is good enough. I think it normally routes through ArcX if I'm not mistaken. But again, just leave this on auto. Don't overthink this. That's not really the important part. So the important part is when we get here to order. And let me get back to that real quick. So action is going to be either buy or sell, or buy back to cover, or sell short. And if you don't know what buying and selling, shorting is, you know, there's some videos on that. You can probably go look that up. But the main point of this video is to talk about orders, because that is what a lot of you guys may not understand really in depth. So the first most basic type of order is called a market order. And what this order means is you want to buy the stock at the current price that it's trading at, no matter what that price may be. And this is a little bit dangerous, especially if you're trading extremely volatile stocks, because they can have wild price swings, and there could be a market maker who decides to execute you, you know, 10 or 20 cents away from what the current price of the stock is. And it could be 5% off, and you just lost 5% like that because you use a market order. This can also depend on your broker a lot. Fidelity is really good at getting you the best price. I've found they always give me price improvements. But if you have a broker like Robinhood, you're going to be getting horrible executions. And they actually have like these outside services. They don't even fulfill your orders. They don't even give you the shares. They send your order to an outside, I guess, routing service, and then those people give you the price that, you know, they feel is best. And normally, if you use a market order on Robinhood, you probably notice this, like you get in at a way worse price than it's normally trading for. So the stock could be trading at 270 and you get in at 265, and you're like, what? I just saw it print 270. What is going on here? That is why. So again, they give it to like an outside company, and that's why market orders are very dangerous, especially on these fast-moving stocks. And the other time is when there's a big spread. And if you don't know what the spread is, I guess I can't. Well, I guess I can show you a little bit here. So this is a pretty good example of the spread. So you can see here on BGI, the bid is 112 and the ask is 116. So if you buy at market, chances are you're getting it at the higher price. You're getting immediately taken off at the ask because there's someone willing to sell at that price. So just be aware that if you're using a market order, a lot of times you're going to be getting a worse price. Now, the thing that market orders are good for is typically, at least on NASDAQ stocks, you get executed like that. You get executed instantly. And if you're trying to get out of a position very quickly, this can be better than trying to fumble with an order. You misplace it, suddenly you have to cancel your old order, retype out a new order. That can be frustrating sometimes. So if your most important thing is speed and you're willing to sacrifice a little bit of, I got to run the dishwasher. I'll remind myself in an hour. If your most important thing is getting out quickly and not at the best price, then use a market order. But typically, I don't like to use market orders, especially when I'm buying, because when you're buying, your entry is super important. If you want to sell quickly, market orders can be okay. So what is next? Well, the next type of order is a limit order. And this is the order that I typically use on a day-to-day basis because it gives you full control over the price of the stock and where you're getting in. So let me give you a good example of when you would want to use a limit order. So you see on this stock here, it popped up, came back down, spiked up through 140. That's what that line is. Came back down and bounced off of 140. And now it's up here at 160. And you're thinking to yourself, all right, well, I want to buy this stock, but I don't want to buy with a market order because I don't like the price of 160. I think 140 is a place that this stock could probably bounce again because it bounced here, it bounced here, and then it bounced here. So I think 140 could be good support. I'm going to put in a limit order for 140. And here's what this means. A limit order is you want to buy this stock at any price below your limit price. So you're putting in an order to buy the stock at anything 140 or under. So if the stock is trading at 110, you could still put a limit order for 140. But if it's at 160, you put that limit order for 140. You don't get executed right away. The stock keeps trading. It keeps trading. But then it comes back down here and it touches 140 and suddenly you're in at 140. And then the stock bounces again and goes on to rip and continue to make new highs. And just keeps going and going and going. That is the beauty of a limit order. And it really allows you to have better control over your price entries and make sure that you're getting in at a good spot. And that is why, again, I love using limit orders. They're also great when you have these big spreads because a lot of times if there's a bunch of sellers, you can get in on the bid, put a buy order on the bottom, and then as soon as it bounces, you can put a sell order limit on the top and, make that difference. So definitely use limit orders whenever possible, especially if you're trading these super volatile stocks. And OTCs, it can be very, very helpful to have limit orders because a lot of times there's massive spreads in OTC stocks. And those are stocks that are not listed on the NASDAQ or New York Exchange. OTC is a worse exchange if you guys don't know what that is. Definitely do some research on it, but executions are a lot slower on OTC. Now, let's keep going down. So what are other types of orders? The main other types of orders are stop orders. And there's a couple different types of stop orders that I want to talk about with you guys. But essentially, they all revolve around using the similar types of orders that we already talked about. So there's a stop, just a normal stop order, which is technically a stop market order. And there's a stop limit order. And then we also have trailing stops. But let's start with the bland, typical stop market order. And what does that mean? A stop order is when you have a specific price that will trigger your order to be released, if that makes sense. So say I wanted to, let's call it right here. All right, say I think once it breaks out over this level, it's a really important level. So say I want to place an order only if it's able to break out over this price of 140. Well, I could put a stop order, a stop buy order right here with the stop price of 140. And as soon as this stock prints 140, as in someone exchanges shares at the price of 140, I will put in my market order to buy my shares, however many that might be. And this is a great way of getting in at a certain price. And again, you can put this on the downside. This is called a stop loss, and this typically prevents you from losing more than you want to on a stock. So say you buy in right here and you're thinking, all right, man, if this thing goes under 150, I'm out. I'm putting a stop loss at 150. As soon as it prints the price of 150, you have all of your shares converted to a market order to sell. And whatever price you get for that, you get for it, but you're out. You're not going to lose any more. That is what is nice about a stop loss or stop orders in general. I prefer to use stop limit orders, at least when I am getting in. So if you see here, you could use a stop limit order. You don't know how fast this is going to spike. It could go directly from 140 to 150 without you being able to get executed. And you might not want to get in at 150. That might be a little too high. So you could say, all right, I'm going to have a stop price of 140. So as soon as it hits 140, my order is sent to the market. But the stop limit means you can have a limit on that. So I am sending my buy order to the market at a limit price of 145. So as soon as this stock touches 140, I have a limit order sent to the market for 145. And that ensures that even if it spikes up immediately, you're not getting executed at that worst price, which is really nice. This can be a little dangerous if you're using this as a stop loss because sometimes the stock can fall faster than you can get in. So say you have a stop limit. Say you put it, your stop is at 120 and you wanted to get out at 115 maximum, but it might fall down to 113 before you can get executed. And now it's trading below and your limit is at 115, you can't get out. You're still holding your shares. So in that case, using a stop loss that uses just a market order can be a little better. It can be a little safer because it guarantees that you get out. So that is typically when I would use this. Honestly, if I'm using a stop limit order, normally I'm going to be using it to make sure that I can get in if a stock breaks out past a key resistance level. So that's when I would use it. Again, in this case, I would probably put this at 140 and maybe put the limit at 143 or something like that because I want to make sure that as soon as it prints 140, I'm getting in below 143, at 143 or below. I don't want to get above that because that would be a bad entry, but if I can get in at that price, I think it's likely to continue on up. So that is when I would use that. The last one that I want to talk about, and there's obviously a couple other ones, but the last main one that I want to talk about is called a trailing stop loss. And the reason this is great is it allows you to protect these gains on your stock if you're already positive on your position. So just for example, let's say you bought in call it right here, okay? So you bought in at 120 and you want to sell this stock if it drops under $1. So you could put in a trailing stop loss for 20 cents. And you can also do it based on percentage, of 5%, 10%, whatever. But call it 20 cents. So you say, if this stock ever falls 20 cents from its high point, I want to sell it and get out. All right, so you get in here, right? You get in at 120. It goes up, it goes up. Now the new high point is 170. It falls down 15 cents, but it never falls down below that 20 cent area. And then it keeps on ripping, keeps on going up. It goes on up to, 225, and then it falls down to 206, but it still doesn't hit the 20 cent area. And then it goes on up to $3, and it comes back down another 10 cents, but it still doesn't fall 20 cents from the highs. And it continues all the way up here, and then it falls down 20 cents, and you end up getting out at 333. Can you imagine that? That is such a great way of locking in your gains when you don't have to even watch the stock. And that is why trailing stop losses can be so great, especially if you're not there to watch what the stock is doing. Because imagine if you just used a normal stop loss in this case. Say you don't want to get out at a price below, $1. You want to make sure you lock it in, make sure you prevent huge losses. So you buy here at 120 and you put a stop loss at $1. This stock goes all the way up here and then it falls all the way back down and you lose money because you get out at $1. To me, that doesn't make any sense. So, if you're up on a position, you always want to use a trailing stop loss if you can't watch it because you never know how high it can go and you want to make sure that you allow it to keep running and then protect those gains as they come in. It doesn't make sense to have a normal stop loss if the stock is continually going up because your stop loss is staying at the same spot, but it's going higher and higher. So your profits are growing, but your stop loss isn't protecting that. So that's why it doesn't really make sense to use that one in this particular situation. So I definitely recommend using trailing stop losses if you're ever at a point where you can't watch the stock, but it's going up and you want to let it continue to go, but then lock in your gains once it starts to fall. Trailing stop losses are a great option for that. Just, use the chart and figure out what type of amount you should be using. Because if you gave it a 5-cent trailing stop, you would get stopped out down here and you wouldn't be able to enjoy all of these massive runs. So definitely, give a little more room, but do it based on the chart, you know? Every single time it falls, what is approximately how much it falls, and then make it just a little bit more than that, because that should prevent you from getting stopped out in one of these areas if it's, you know, continuing to trend upwards in a channel like this. Some of the other orders that I just want to briefly mention, there's pegged orders. I don't really use those. There's reserved orders, and reserved orders are basically how people hide their massive orders. So someone could be having, I don't know, 100,000 share order, 1,000,000 share order, but they don't want to scare people, because if you watch the level 2s, you can see if someone's trying to sell 1,000,000 shares. And if someone's trying to sell 1,000,000 shares, you're not going to be buying your 100 shares, because you know it's going to go down and you're never going to be able to break through that wall of sellers. So when people have that many shares, most of the time, what they do is they hide their shares, and it's what a reserve order is. It displays, say, 1,000 shares, but really they're buying 1,000,000. So even though it only says 1,000 on the level 2, you can never ever break through that wall, and it just keeps printing 1,000 at that price, and then it's going to fall back down eventually because the buyers are they're gonna go away. And you can see this on the downside too. We saw this on NCTY. If I go here real quick, so just look at that. There was a line right here at 21, and it literally could not break under that because there was someone propping up the bid. That's another word for it. They have a ridiculous amount of shares that they're buying because they want to sell back into when it bounces because they're shorting. And look at this. It literally cannot break under that. And if you looked on the level 2, there was no type of big buyer, because they were using a reserve or a hidden order. You know, you can even hide it, to my knowledge. You don't even have to show your order at all. And you can see here, it literally could not break down past this 21. And then as soon as it did, man, it just cracked and went down and just fell all the way down. I know someone who made $300,000 on a trade trading this stock because they knew what to look for, and they knew that as soon as that buyer disappeared, that hidden buyer disappeared, this thing was going to crack. And it did. So that is something that you need to be aware of. If you see a stock that's unable to break through a price point, and you're like, what, bro, I see tens of thousands, hundreds of thousands of shares printing, and there's only 1,000 shares on the level 2. What is going on? That is why there is a big hidden buyer or seller on the level 2. So know that that is a type of order that is available. And if you are doing a ton of shares, it's a good way of getting rid of them without scaring people, spooking people on the level 2. So yeah, that is all the types of orders. Again, just make sure that you use limit orders when you can. If you're buying, if you're protecting yourself, make sure you use those stop losses or trailing stop losses. And if you're getting out really quickly, and that's the most important thing, make sure to use a market order. But yeah, be careful of market orders, especially when you're buying in, because you're probably going to get screwed, especially if there's a huge whiplash of prices. And yeah, that is pretty much it for this video, guys. Hopefully you found it helpful. If you did, please drop a like below and comment if there's any other things, you know, general, I guess, basic terminology or strategies for trading, anything that you want me to talk about, let me know and I will make a video about it, because that's what I'm here for. So anyways, I'll see you guys in the next one. Until then, you know the drill. Let's grow better together. Tu boca si te despiertas, mi tiempo también es tuyo porque me inspiras. Solo quiero que seas la única que así me mira.